Now, money does not and cannot originate by order of the state. In other words, the United States government just couldn't print up little pieces of paper and put numbers on them and expect people to take it. It must originate in the processes of the free market. And before there was money, there was barter. Goods were produced by the people who were good at producing a particular good. So if you were extra good at producing something, then you would likely have a surplus of that, and you would be able to trade your surplus for other goods that you needed. And if you had trees on your property and you were a good wood chopper, say, you might have surplus firewood. But of course, man does not live by firewood alone. And but you find a lady down the road who has chickens, and most egg ladies end up with more eggs than they can eat. So the egg lady and the log guy make a deal, and they trade maybe one egg for one piece of firewood. And of course, this works out fine, but we should always recognize as well that these exchanges can change. Say some of the chickens died. Now, if some of the chickens died, the egg lady would have less eggs, and she wouldn't be as willing to part with, say, one of the eggs for one piece of the firewood. She would likely want 2 pieces of firewood for every egg that she traded. Same way with the log guy. Say there was a fire on his property, and he didn't have as much wood, and he might require a couple of logs for every egg that he would trade for. So these terms of this barter and this trade would change depending on the supply and demand of these particular goods. But the big limitation to barter is the scope of trade. The log man has to find someone who both wants logs and someone who has something that he wants. Same way with the egg lady. She has to find somebody who wants eggs, and that particular person has to have something that she wants. And this is called the double coincidence of wants. It's one of the big problems with barter. Second problem is indivisibility. Now, we can chop up these logs, make them smaller, and work with them fairly well. But eggs, well, they don't chop up very well, unless you wanted to scramble them and do it that way, but that wouldn't really work for our purposes. So indivisibility is a problem with barter. Another problem is business calculation. Business firms must be able to determine whether they're earning a profit or a loss, and this is impossible to do under a barter system. Now, since not many people want to trade for what an individual person has in excess for, he or she must find other very marketable goods that they can trade with. So the log person may store up on another quantity just so that he can use that other quantity to acquire other goods. And that's using those goods as a medium of exchange. So you may not acquire extra logs, or you may not require extra eggs or extra fish or something like that, but you would acquire these goods because you knew they were marketable to other people, and you would use those as a medium of exchange. And as people see a certain quantity or a certain commodity as a medium of exchange and see that it is highly marketable, that is when this medium of exchange becomes money. Now, money is a huge leap forward in the history of civilization. It permitted man to overcome the obstacles of barter, and businesses could then calculate whether they were making or losing money. All goods could be priced in one commodity instead of several. Now, a number of things have been used as money over the years. I'm sure you've heard about these things: salt, sugar, cattle, cowrie shells, tea, and even cigarettes in prison camps have been used as money. Now, what will be picked as money? What are the characteristics that make a commodity a good money? And the first thing is that it be generally marketable. In other words, it has a high non-monetary demand. And that's why you can see these things throughout history had high non-monetary demand, like salt, sugar, and things like that. Everybody needed them, everybody used them, so they were generally very marketable and they were used as money. The other thing is divisible. What makes a good money is something that can be divided into smaller units. Number 3, high value per unit weight. That means it's portable. Now, cattle doesn't really fall into that category. So I think using cattle as money didn't last very long and wouldn't be particularly practical these days. A good money has to be fairly stable in value. That's number 4. It should hold its value over time. It should be durable, number 5. Number 6, it should be recognizable. Everyone should recognize this particular good as something that has value. And it should be homogeneous. It should be like very consistent in what it is. So over time, 2 commodities have been the most dominant to compete as money, and that's gold and that's silver. And I have some gold right here when it was money. This is a 1895 gold piece. It's unfortunately we have to put plastic around it so my grubby little hands don't, ding it up or anything. But an ounce of gold in 1895 is a $20 gold piece. So this is what $20 used to look like in 1895, back when money was real money. And I don't know if that'll show up. Yeah, you can see how. No. No. I'm sorry, I'm not going to pass that around. If my lawyer were here, I would have her follow it around and do that. But you know where to find me. These are very, very pretty coins. And you can see on there, it does say $20. I don't know if you can make it out very well, but that's what money used to, what it used to be. And of course, gold and silver both were highly prized for their luster and for their ornamental value. They've always been in great demand. They're relatively scarce. They're valuable per weight, and they're very portable, and they're very divisible. Gold is virtually indestructible. You can pull it into a wire miles and miles long, very malleable, and so both gold and silver, very durable and make the perfect money. So the next thing to talk about is what should the supply of money be? Now we hear this all the time. You probably look for money supply figures every week, every month to determine the money supply. But as Murray Rothbard wonders, economists would never ask the question, well, what should the supply of biscuits be, or shoes, or titanium? So even with other goods, we don't worry about what the proper supply is of these goods. But everybody seems to be worried about what the money supply is. Yet we let the market determine what the supply of biscuits is. And so Murray asked, why shouldn't we do the same thing with money? But money is different than biscuits. The more biscuits we have, the better off we are. The more Chick-fil-A sandwiches they can make out of these biscuits or whatever. And The more plants and equipments we can make, to make these biscuits, that's all the better. But money is different. The more money we have, that doesn't mean we're better off. Even though money is indispensable to production and exchange, it is simply transferred from one person's assets to another. As Mises wrote, any supply of money will be equally optimal to another. Doesn't matter what the supply of money is. To increase the supply of money only dilutes the purchasing power of the existing money. So if overnight the supply of money was doubled, we wouldn't be any better off. Society would be no better off because the real resources, labor, capital, goods, natural resources, productivity, that hasn't changed. Prices overall would double. No one would be better off except for those who received the money first, because they would be able to spend their newfound cash prior to everyone else, take advantage of lower prices. But overall, society would be no worse off with more money. But of course, we hear day after day after day that the Federal Reserve, the Treasury, they need to create more money, they need to create lower interest rates so that we'd be better off, but it's just not true. The market's perfectly capable of deciding what the money supply should be. There's no need for it to keep up with population. There's no such thing as a proper supply of money. Now, if gold was money, the only way to create supply would be to mine more of it. And it would only be mined if it was profitable to create that money. But the other way to create money is counterfeiting. Instead of going to the trouble and expense of mining gold, you might take brass or plastic or some other substance and try to pawn it off as gold. And of course, one of the reasons gold's universal acceptance as money in the free market is it's very difficult to counterfeit. Its look, its sound as a coin, very easily recognizable. Its purity can be readily tested. And I wish this wasn't wrapped in plastic. I'd drop it. Well, I probably wouldn't drop it on that machine, but you would see how heavy it was. How many have never held an ounce of gold? Have you all held a lot of you have never held an ounce of gold? Oh, well, we may have to do that before the week's out. Because it'll have a profound effect on you. You won't want it pried from your cold, dead fingers, as they say. It's a wonderful substance, and it's very, like I say, it makes the perfect money. So that any type of counterfeiting dilutes the value of all the existing dollars, and counterfeiting is an inflation process that injures all legitimate money holders because their purchasing power is diluted. Counterfeiting defrauds and injures everyone. But not everybody is harmed equally. As I said before, the counterfeiters benefit first. If you get the money first, if overnight the supply of money was doubled and you had access to it first, then you could run over here to Mama Goldberg's and Chick-fil-A and use your newfound money to have a run on chicken sandwiches and turkey wraps, probably driving up the price for those who didn't get their money till later in the day, who would experience higher prices. Now, the government's supposed to apprehend counterfeiters, and they do. Believe me, if you want to go to jail, just get into the counterfeiting business, because they don't like the competition. And that's the point here, is that the primary counterfeiter is now the government. And it was the invention of paper money that allowed government to really get into the counterfeiting business. And at this point, I have something that you've probably seen before. It's a $20 bill. What used to be $20, what $20 is today. Oops, upside down. Poor Andrew. made the first central banks go away, and now he has to adorn a $20 bill. It's too bad. Now, kings had long since granted themselves the monopoly on minting coins, and when the treasury would run low, what they would do when they needed to pay for wars, pay for other social programs. Oh, what do you got here? What? Oh, okay. There we go. Anybody else have anything they want to put up here? Presuming it has some kind of value. Anyway, kings have always granted themselves a monopoly, and when they ran low, they would what was known as sweat, clip, or cry coins. In other words, they would confiscate the coins, and they'd shave little bits of it off, and then collect that money and create more coins than to pay for their nonsense that they were engaged in. But this process was slow. It didn't generate enough money as quickly. The king always needed money, so the next step was writing paper tickets supposedly backed by gold. And governments couldn't start printing tickets. They just couldn't start printing tickets and having contractors take the tickets as money. As I said before, contractors would only take these paper tickets if they thought that they could be exchangeable into gold and silver. And of course, government also compels the acceptance of these paper tickets by passing legal tender laws. And that's what we have today. You have to use that $20 bill right there in use of exchange due to legal tender laws. Now, when the government inflates or counterfeits, it benefits first and foremost because it gets the money the first, followed by government contractors who then receive the money. Those on fixed incomes or pensioners, they are the ones that are hurt the most because they receive the money last. And only when there is paper money that's been accepted for a long time is the government able to make paper money irredeemable, cutting the link to gold. So there is nothing standing behind this $20 bill. Now, you will occasionally run into someone who says there is a bunch of gold in Fort Knox standing behind that 20. And that is not true. But there are quite a few folks, and generally older folks, that believe that's true, but it's not. That is just backed by the full faith in government, full faith and credit of the United States government. And I'll let you decide how much that is worth. And as Murray said, when government was able to print money that is irredeemable, he wrote, "The government is now in seventh heaven." They don't have to be constricted by the amount of gold, and they can print as much as they want of inflationary issues of government paper. And of course, gold's considered, we know from Maynard. That's who Murray Rothbard used to refer to John Maynard Keynes as Maynard. I don't think it was exactly a term of endearment, but of course, Maynard used to say that gold was a barbarous relic, and it was old-fashioned, and it was sophisticated, cool people that dealt in paper money. So, and it was only nut jobs that want to use gold. Well, I guess I'm in that nut job category. So probably a few other people in the room are as well. So we've looked at the supply of money. Let's look at the demand of money. The demand for money is not talked about very often. The supply of goods and services increases in a commodity, the demand for money in exchange will also increase. An increased supply of goods produced will raise the demand for money and therefore lower overall prices. And historically, the supply of goods and services has risen every year. And this increase in the demand for money will tend to lower prices over a period of time. Prices fell from the mid-18th century until 1940, with the exception of war periods. And of course, that's when the government would create money any way they could to engage in war. Now, the demand for money is affected by the frequency in which people are paid, their salaries or wages. And the less you're paid, the less often you're paid, the more average balances you need to maintain. In other words, if you're only paid once a month, you need to hold on to higher cash balances to satisfy your bills over the course of that month. And if you're paid twice a month, you don't need to hold as high cash balances because you know you have another paycheck coming in between. So the less frequent the payment, the higher the cash balance, therefore the greater demand for money. Greater the amount at any price level that a person will seek to keep in his cash balance. People on commissions or self-employed should and do carry higher cash balances. They're paid less frequently. Their payments are sometimes uncertain. So they should keep higher cash balances, and they do for those two reasons. Technological changes also affect the amount of money that you need to carry. Credit cards are an excellent example. If you have a credit card, your need for carrying cash is decreased. In fact, upon moving to Auburn, I found out that, I can use an Auburn money clip. This is what one of those looks like. This happens to have NASCAR on it. That's pretty cool. The Southern thing. And you can see it doesn't hold very much money, but I don't need much money here in Auburn because I can get most everything I need with credit cards. I don't need to have cash either in my account or carry on. Now this is a Vegas money clip. And because this is what you need in Vegas because you're carrying lots of cash. So you put your roll of dollar bills, hundreds in here to walk around in Vegas. And you can get these at Piero's restaurant, one of my favorite restaurants in Vegas. And it's an official Vegas money clip. All the big-time high rollers walk around town with all their money in a rubber band like that. So anyway, that's the difference between the amount of cash you need to carry. In fact, the Japanese are thinking about outlawing cash. Don't know if you've read that. Japan's still mired in a depression, recession for the last 20 years, and they think that if they outlaw cash, then they'll be able to stimulate the economy. And the Japanese tend to want to carry a lot of cash. I understand they typically, cash balances are more like 16% rather than 2 or 3% in other parts of the world, so they want to outlaw it. And there's a reason. Money that's left in banks can then be created out of nowhere more easily. So there is something to that. Now, whether they're going to be able to pull this off, who knows? But that's the latest plan out of Japan that they're kicking around to get out of their 2-decade-long funk that they're in. So, but these technological developments that economize cash will tend to cause demand for money to be reduced and prices to increase. But it's really the public's confidence in money that must be strong for the demand for money to be high. The demand for paper money is always very volatile, and it's driven by confidence or lack thereof, while at the same time the demand for gold and silver is always very high. So it's this public expectations of future price levels that's far and away the most important determinant for the demand for money. And the demand for money rises if it is expected that prices will fall. And the demand for money will fall if the public expects prices to increase. Now when you first hear it, sometimes that doesn't make sense, but when you think about it, If people expect that prices will stay the same or fall, they want to hold their cash balances, wait to make some purchases, not all purchases, but some purchases, while at the same time, if people believe that prices are going to increase, then you're going to want to trade your cash for the goods and services before they go up in price. So again, the demand for money rises. If it's expected that prices are going to fall, demand for money will fall. If the public expects prices to increase. Deflationary price expectations mean lower prices. Inflationary price expectations mean higher prices. Expectations don't change suddenly. It takes time for this to happen. And again, it is based on the record of the immediate past. These expectations are sluggish and in revising themselves to adapt to new conditions. Mises outlined the typical inflation process that was based on the German hyperinflation of 1923. In phase one, prices didn't rise near as much as money supply because the public was still and had deflationary expectations. So the government at this point thinks it's great, they can print all the money they want with impunity. But in phase two, instead of a rising demand for money moderating these price increases, a falling demand for money will intensify price inflation. And then in phase three, prices go up faster than money supply. Then there's a shortage of money. People urge government to print more money, and if the government does this, prices and money spiral upwards. The value of money is disappearing. Even as I sit here and contemplate it, I must get rid of my money right away and buy anything. Matters not what, so long as it isn't money. It's kind of like my girlfriend in a shoe store. That was a funnier line than you gave it credit for, but that's fine. I was expecting the faculty to pick up the slack there, but they didn't. So the demand for money falls to virtually zero when this happens. And in the German hyperinflation, workers were paid twice a day. Housewives would stand at the gate in the factories with a wheelbarrow and the money to store, and then they'd take the money in the wheelbarrow to the store and buy anything. Anything was on the shelves. Production fell. People became more interested in speculation than in working for wages. Germans began to use foreign currencies or to barter, and the mark completely collapsed. And to illustrate this, in 1914, one German mark equaled 1/4 of a dollar. That was in 1914. By October of 23, it took 25.3 billion marks to equal a dollar. 1 month later, it took 4.2 trillion marks to equal a dollar. So when you hear in the news lately about worries about hyperinflation, you can just imagine in a month or in a period of years, everything that you'd saved and you thought you had a nice nest egg to live your golden years on maybe would be reduced to paying for lunch or buying a tank of gas. It is a frightening thought. And yet we have a Federal Reserve and a government that continues to pound the table and worry about deflation. Yet it is inflation that they're creating. This was changed by the Germans, and they changed their currency and created a Rentenmark. Essentially, one of those became 1 trillion marks, soaked up some of the currency. They stopped inflation. And the Germans, and of course you've already heard from Professor Holzman how smart the Germans are over and over, and I'm sure you'll hear more of that. But they have hyperinflation burned into their memories. Americans do not have that burned into their memories, but they may yet, before this is all over. Now, I wanted to leave the subject of money and go to something that I know a little bit about because I was a banker, although most of this banking I'm going to talk about I never engaged in. But we're going to talk about banking for the second half of this. And I'm going to start with loan banking. Actually, I was a loan officer, made real estate loans till that didn't work out very well. But loan banking is straightforward enough. If I wanted to start a bank and save some money, I might start a bank and I would initially loan out my own money and earn the profit from the interest that I had earned from the borrower who would pay, and the loan would be repaid, and you would do it all over again. You may want to take in investors. You might want to sell bonds, and then again, you would loan that money out, and you would earn a profit on the difference between what you'd pay the bondholders in interest and what you would receive from your borrowers. And the banker would get paid for being an expert on where its loans should be made and to whom, and would reap the award for this service. There's no inflationary action by being a loan bank. The money's been saved, a present good has been traded for a future good, and the money has been lent out. So there's no money being created out of nowhere in this case. If the bank makes unsound loans and goes bankrupt, as in any other kind of insolvency, its shareholders and creditors would suffer the losses, and that bankruptcy would be no different than any other. Unwise management or poor entrepreneurship would cause the harm to the owners and the creditors. Now, a good example of straight loan companies are what I call hard money lenders, finance companies, and factors. Those are all loan bankers. And an example of a factor, if you're not familiar with that, is CIT. Now, you may have heard of CIT in the news. They are on the brink of bankruptcy. They were saved by some of their bondholders, extending them another $3 billion, but I think that's only going to last them a month. But again, they don't have depositors. They have more bondholders. Hard money lenders were lenders in hot real estate markets that would loan on real estate. Developers who couldn't borrow from banks, didn't want to borrow from banks. A hard money lender would gather a pool of saved money from investors, pool it together to make real estate loans. Generally at high rates of 12%, 15%. So even when prime was 1 and we might charge 2 or 3 over prime for a loan, so the bank's getting 3 or 4, the hard money lender would be typically getting 11 or 12 for the same kind of loan. Because generally people who have actually saved the money and are foregoing consumption, they don't generally want a higher return than somebody that just has their money in the bank that is FDIC insured. So many of these hard money lenders have been devastated through the real estate crash, but you don't hear a lot about them, but I would predict that you will hear more and more, because there's been a lot of investors who've lost a lot of money investing through hard money lenders because they didn't think real estate would ever go down in value. And they are learning that lesson very quickly. So let's turn to deposit banking. Legitimate deposit banking is based on, in my view, honoring property rights. If you put money in a bank, especially in a demand deposit account, you probably consider it your money, right? If you have money in the bank, does anybody here, if you've got a checking account, do you think you've lent the bank money? You think you have? You've lent it to them. Okay. A lot of people would, so on your balance sheet, would you, that money, would you call it cash or would you call it loan to bank? Or loan receivable from bank? in a demand deposit where you can pick it up anytime? Yeah, not talking about a CD in this case, but demand deposit, most people would consider their money. They can go and get it any time. Whereas in a CD, you have lent the bank money for a certain period of time, and you have a contractual obligation, and they can do what they will with the money. But most demand deposits, if you put the money in one day, you can go back and get it the next. And so you have the expectation is that they're holding the bank, holding that money for you, but that's not the case. All men, of course, this started with the goldsmith bankers a long time ago. People would put their gold with a goldsmith banker, and he would hold their gold. Eventually, these goldsmith bankers would say, gee, I think I can print more tickets than I have gold because I don't think everybody will show up for their gold all at once. And the more tickets I have out, the more money I can create and the more money I can earn. And that's what's happened. I mean, all men are subject to temptation to commit theft and fraud, and the warehousing profession is no different. And short of just flat stealing the depositor's stuff, in this case the money, warehouseman would borrow it temporarily with the hope and be able to hopefully profit by the speculation and then return it later. Of course, this is called embezzlement. Embezzlement in the dictionary means appropriating fraudulently to one's own use as money or property entrusted in one's care. And of course, nothing is more tempting than gold bullion or money for embezzlement because gold is fully fungible. So these goldsmiths, deposit bankers, virtually always embezzled because it was profitable to create money out of nowhere. So over time, bankers and government have found it important to find an adequate theoretical justification beyond the easy solution of simply declaring legal a corrupt criminal practice, which is ultimately what happened. But what happened in 1811 in Carr versus Carr was a very important court case, and that is when the court determined that the debts mentioned in a will that it was included as cash balance in a bank deposit account, the Master of the Rolls, Sir William Grant, ruled that it did since the money had been paid directly into the bank and was not earmarked in a sealed bag. It had become a loan rather than a bailment. 5 years later, in Devanes versus Noble, the same judge ruled that money paid into a banker's becomes immediately a part of his general assets, and his is time merely a debtor for that amount. 1848, Foley versus Hill and others, Lord Cottenham ruled money, when paid into a bank, ceases altogether to be the money of the principal. It is then that the money of the banker, who is bound to an equivalent by paying a similar sum to the deposited with him when he is asked for it. The money is placed in a custody of banker to do what he pleases. So we had this series of court cases that turned deposit banks from bailment and essentially created the legal justification for what we know as fractionalized banking. Now, all these court cases remind me of a scene from a John Wayne movie. There's a movie called The Comancheros. I don't know if you've seen it, but Circuit Court Judge Thaddeus Jackson Breen says to Paul Regret, "Major here has told me about your troubles. I've been thinking it over in light of my 40 years experience in legal jurisprudence and have come to the positive conclusion that there ain't no way to do this legal and honest, but being good, sensible Texans, we'll do it illegal and dishonest." So I think that kind of wraps up the way the courts have held on the deposit issue. So law's been deliberately ambiguous to legally justify fractional reserves, and this is needed because fractional reserve banking cannot survive economically on its own, must be supported by government force. in the form of a central bank which institutes the regulations and supplies liquidity necessary at all times to keep the apparatus going. So what we've done now is, you can see we've married, if you will, the loan bank with the deposit bank. And that's when we create fractional reserves. So if you put $100 in the bank, they don't have $100 of your money waiting for you. They probably have lent out $90 of it. And the hope is that not everybody shows up to get their money all at once. And of course, when things go bad, there's rumors out that loans aren't being paid off because of the $100 you put in the bank. The $90 was lent to the real estate developer down the street who built some houses that he can't sell anymore, so he can't repay the loan. So people get wind of this and they want to come and get their money. And when everybody wants to show up at once and get their money, and it doesn't take everybody, if say 5 or 10% of the people want to show up and get their money, they can't get it. So you have what's known as a run on the bank. And the last time there was really runs on the bank was from 1929 to 1933 during the first Great Depression. And we had 9,200 banks fail in the United States. So we haven't had this many fail this time around, but we are on our way. I'm not sure it'll be 9,200. There were many, many more banks back in the early 30s than there are now. So, but 92 of them did fail. We actually only have about 8,500 banks in total in the United States right now. And I think as of last Friday, 7 more banks failed. I think we're up to 64 or something like that. So a fair number of failures now with this real estate meltdown. Now, fractional reserve bankings by themselves is very constrained because deposits will want to be redeemed by customers of other banks. So if you have your money in one bank, you write a check to your friend banks at another bank. That bank will redeem that check for this bank. So the bank, to stay in business, will always have to maintain reserves to honor those checks. Now, if everyone banked at the same bank, this would not be an issue. If I wrote a check to Mark Thornton and we both banked at Auburn National Bank, my check would just go from my money would go from my account into Mark's account, stay in the same bank. There would be no redemption, and all would be well. So even if there were free banking, that would not be an issue. So the fewer banks you had, with the more customers you have, the more that you can inflate. But the more banks you have with the fewer number of customers, the harder it is. So what was needed to have commercial banking with many banks and still have the apparatus to create money, what you needed was a cartelization system. And that came in the form of the Federal Reserve, which was formed in 1913. And central banks, either government-owned and operated, or else especially privileged by the central government. Of course, you'll run into plenty of people who will say that that our Federal Reserve is private and all would be well if it was just run by the government. But somehow the fact that the Federal Reserve Chairman testifies before Congress, is appointed by the President, I think would seem to tell you that the central bank is there and essentially controlled by the federal government. So the idea that it is private is a misnomer. So how do we create money in a commercial banking system? Hopefully this will show up. Not my eye. Not too bad. You guys in the back are going to want me to shove this up here. All right. So I wanted to pick a big, strong bank to use as an example, so I stumbled onto Citibank. We know how good a shape they're in. And first transaction we have is that the Fed buys treasuries from Citibank. And you can see what happened. See what happens here. There was somebody named Jones that had deposits in Citibanks for $1,000. The Citibank had taken Jones's deposit. They had U.S. government securities of $1,000, but the Fed wanted to expand the money supply and wanted to expand. So what they did was they bought $1,000 worth of bonds from Citibank, and so Citibank has essentially a demand deposit at the Federal Reserve. Federal Reserve has an asset for the government securities that they bought from Citibank, and now Citibank has $1,000 in reserve to lend out. Now, you know, Citi's not just going to sit on that money. They need to find a creditworthy borrower, and you can see that they find Donald Trump to borrow some money. And what we're assuming here is a 10% reserve ratio. So of the $1,000 that Citi had on deposit with Jones, they lend $900 to Trump, and so what it looks like now is that the assets of Citibank is a loan to Trump for $900. We have a demand deposit still there from Jones because nothing's happened to that. The loan to Trump becomes a demand deposit to Trump. So that totals $1,900, and then the reserves are still there for $1,000. So our T account balances, and we've gone from $1,900 then from $1,000 to $1,900. Now Donald's not a guy that sits on his money very long. He's got bills to pay, and the first bill he's got to pay is to his ex-wife Ivana, but she doesn't bank at Citibank. She banks with the friends of the government over there at Goldman Sachs. And so she writes a check to Ivana. And so now Citibank has a asset in the form of a loan to Trump for $900. They got a demand deposit to Jones for $1,000. Reserves of $100. And then Goldman Sachs, our bank B in this case, has a demand deposit to Ivana for $900 and reserves of $900. Now you can see what it looks like with the Federal Reserve. They've got, still has those U.S. government securities for $1,000. They've got equity and liabilities then, demand deposits with now Citibank for $100 and Goldman Sachs for $900. Now Goldman needs to make a loan because now they've got some deposit money, and they've found a creditworthy borrower in the state of California. And again, using our ratio of holding 10%, they lend 90% of that 900, so 0.9 times 900 equals a loan to the state of California for $810. So our balance sheets now, we have Bank B, Goldman Sachs, got a loan to California, $810. They've got reserves at $900. Demand deposit, Ivana's still got her money there. The state of California now has $810 demand deposit, which is the other side of the loan transaction. So you can see how their balance sheet is expanded. Well, the state of California has bills to pay, and we're going to assume that they have to pay CalPERS. I don't know if you know what CalPERS is, but that's the government employees' pension fund that is woefully underfunded, and eventually the taxpayers are going to have to support that, but that's another story. So anyway, the state of California pays CalPERS. We can see what happens here. We've got Bank B, Goldman Sachs. They've got a loan to California, $810, reserves of $90, demand deposit to Havana still, and CalPERS has their account at Wells Fargo, being a good California company like they are. So, so this is kind of what we end up with in this particular example. Hopefully you can see that. Oops, got to come down a little bit. There we go. Yeah. Citibank at this point has a Trump loan for $900. They got a reserve for $100. Demand deposit still with Jones. Good old Jones's money's been working hard all this time. Goldman Sachs has a loan to California for $110. And reserve of 90, demand deposit with Havana. She hasn't spent her money on shoes or anything else so far. Wells Fargo now has a demand deposit with CalPERS for $110 and reserves for $110. And you can see what the assets of the Fed now are now Treasury securities for $1,000, then demand deposits for $190 and $810 from Citibank, Goldman Sachs, and Wells Fargo, respectively. So this $1,000 that was injected by the Fed by buying that Treasury, over time, if we carried this example all the way out, would have increased the money supply by $10,000 or by 10 times. And that's the magic of monetary creation today. And I think hopefully you can understand that if any of those loans go bad, then you create the situation like really what we have today, where you have bad assets in the form of collateralized debt obligations, mortgages, construction loans, land loans. When they go bad on that side of the balance sheet, that's how banks very quickly get in trouble. And then you have people screaming for a bailout of these banks to keep them in operation. The way it leverages on the way up, when the loans go bad, it leverages on the way back down just as quickly. So it is a highly volatile monetary system and could in no way, shape, or form be considered a sound monetary system. Just to bring this somewhat up to date, maybe this spring you read that the Federal Reserve had committed to buying $300 billion in long-term treasuries, and to do it directly from the Treasury. And actually, Murray Rothbard had something to write about this, and I kind of take the situation that he wrote about it and applied the current numbers, but he wrote essentially to the effect that if the Fed were to finance new Treasury bond issues directly, as it was only allowed by law to do for a while during World War II, this step would be highly inflationary. For the Treasury would now have an increased $300 billion, not just of newly created money, but of high-powered bank money, demand deposits at the Fed. Then as the Treasury spent the money, its claims on the Fed would filter down to the private economy, and the total bank reserves would increase by $300 billion. The banking system would then pyramid loans and deposits on top of that by 10 to 1, in our example, and the modern day example, until the money supply increase would be no less than $3 trillion. Hence, we have a highly inflationary nature of direct Fed purchases of new bonds from the Treasury. So when you hear about this in the news, you hear terms like quantitative easing and euphemisms like that, and they make it sound like really nothing very serious is going on. when you hear 300 billion, which I think we're all kind of getting numb to these numbers, to create $3 trillion in money supply is a horrifying prospect. And if we think again, going back to Germany in 1923 and what can happen to a currency, that is really what's at stake here. So what we've done is we've gone from barter, we've gone to this being $20. Now this is $20, and who knows what it'll be in the future. But essentially, with fiat paper and multiple fractional reserve banking and central banking, we now have permanent inflation. Thanks.